Hello there and welcome to My Finance Teacher. As soon as I post my expectations of crude oil going down into the cycle low, especially with the new administration wanting prices as low as low 40s, of course, political black swan, new sanctions, the stringent sanctions we've seen so far, and price of crude oil shoots through that 200-day moving average. But as history suggests, these geopolitical spikes don't usually maintain and sustain the prices at significantly high levels, so a bit of a cool down, again possibly down into that cycle low, is expected now sometime into perhaps February. That will bring us pretty close to the average cycle duration, nearly 5 months or so, with another opportunity to re-enter into the producers if you feel that you've been missing out on this crude oil price rally over the last couple of weeks or so. Of course, another possibility here, which I would probably give only 40 to 50% chance, so quite a likely scenario but not the primary one, is that we've seen the cycle low over here in the beginning of December, meaning that the new ongoing crude oil cycle is only 38 days long, meaning that any sort of a cool down into the cycle low wouldn't take place at least into March. But again, this would be a less likely scenario. After all, the new upcoming administration has promised lower crude oil prices, RSI has dipped into overbought area already, and we see a couple of pokes above relatively wide Bollinger Bands. All of these suggest more of a cautious approach rather than trying to catch up with this rally into a new relatively young cycle. And yet another relatively short cycle, that would be a record short since 2017, isn't extremely likely after a series of relatively short cycles going all the way back into late 2021. So if we're still in an ongoing cycle, the cycle is already 125 days long. On average, these cycles last for around 159 days. We only have about a month into the typical cycle duration where you would expect a cycle low. Hence, with these overbought signs, you probably do want to be cautious. That's as it relates to producers, though the thesis of that post from last week I had still stands, especially in the longer term. If the new administration wants to increase crude oil production so that prices do drop down, perhaps even down to the levels of 40, although that's probably going to be quite difficult to achieve, nevertheless, some softness in price might be expected. But with all of that drill baby drill, with the volume spiking up, perhaps it's not a bad idea to gradually switch away from production to services. Some of those, by the way, do pay a nice dividend as well. For example, some of the pipeline services, they do very well with larger volumes while paying you a relatively good dividend as well. So to sum up, don't be too greedy with trying to catch up with this rally in crude oil. RSI is already at 74. And zooming out historically, all the way since the pandemic low, out of these 1, 2, 3, 4, 5, 6, 7, 8 spikes into the overbought area, we've only seen 2 of those continue with significantly higher crude oil price. With the previous one into the Russia-Ukraine conflict, and the one before that in late 2020 when crude oil was still recovering from extremely low levels during the pandemic crash. In all of the other cases when RSI has already spiked into the overbought area, the price was not that far from the cycle top, suggesting a bit of a patience for another buying opportunity, perhaps also switching into services and collecting some of those attractive dividends while waiting. For much more detailed and regular updates, make sure to join us at myfinanceteacher.org. Soon we have an outstanding biotech review coming up, make sure you don't miss that. So again, that's myfinanceteacher.org. And that's all for now. Have a marvelous Monday. Bye bye.